This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our introductory lectures, which by now, of course, you should have watched and studied well, and if you haven't, I do suggest that maybe you put a pause on this and go back and watch those introductory lectures, wherein we saw our introduction to the various taxes that make up our syllabus for the Tax UK paper. And looming large amongst those taxes was income tax, the first and the major personal tax. Personal taxes, those which affect us, the individuals, rather than corporate tax, of course, that we also mention, but comes along in these lectures at a much later point in time. We start with personal tax and very specifically with the big one, and that here is income tax. And what we said about income tax is that we would be required, in reality we are required, and your exam may equally and more importantly require you to prepare the income tax computation. An income tax computation, it's a bit like a statement of profit or loss. A statement of profit and loss shows for a given period of time, there it is the accounting period, the amount of profit that has been made for that period and the contents of the making of that profit in terms of the sales and the expenses. What we have in income tax, governed by HMRC, is a set time period, not an accounting period, but a tax year. A tax year, which we said, and we'll see in a moment's time, has some very strange dates. For us, our particular tax year will be known as the 2021-22, 2021-2022 income tax year. And I said it has some very strange dates indeed. But if we look down to now the second part of these notes, we'll go through all of them, of course, as we go through this lecture. But an income tax computation here is prepared for each taxpayer, every one of us, whether child, adult, male, female, single, married, whatever. Every one of us from the day that we're born are welcomed in to the taxation system here within the UK. And this income tax computation will record for each of us taxpayers the income to be taxed for that individual for a tax year. And as I said, the tax year goes back in history in terms of where these dates come from, but runs from April the 6th through to the following April 5th. So our particular tax year, the 2021-22, that's the way we'll designate this particular label of the tax year. For us, with Finance Act 2021, that's the Finance Act, the legislation that gave us the rules that we must now learn, well, at least some of them anyway, we must learn relevant to our syllabus. And the 21-22 tax year runs from the 6th of April 2021 to the 5th of April 22. So it's designated, therefore, by reference to the tax year in which it both started and ended. Now, for that time period, we prepare the income tax computation. And what we have to do is to allocate to that income tax computation for our tax year, the 2021-22 tax year, all of the various sources of taxable income. So where do we think our taxable income will be derived from? Where will any income be derived from? Well, principally, we would think for most taxpayers, it would come from work. And work might either be, again, as we discussed in those introductory lectures, for the vast majority of people, employment income. We are employees of a company or other form of business, be it an unincorporated business, a sole trader business, or a partnership. But we're employees of the business, paid by the business for the work that we can do. And how are we paid? Well, in the form usually of an annual salary. An annual salary that may then actually be paid to us either on a weekly or more usually, and certainly for us anyway in our exam, on a monthly basis. So we would have employment income as a reward for the work that we do. But maybe if having started off as an employee, you then think, I'm going to work for myself, and therefore you become self-employed. Self-employed here as an unincorporated trader. You will trade either as an individual sole trader, which again you'll be used to in terms of your accounting knowledge, or you and colleagues may get together to form a partnership. But those are the two forms of unincorporated trade, where it is the individual who will be assessed to tax. What will they be assessed to tax on? Well, something that does take you back to financial accounting, it will be the profit. It will be a profit for an accounting period. But I hear you say, businesses do not necessarily, whether sole trader or partnership, prepare their accounts to the 5th of April. Not all businesses have a year-ended 5th of April. So that sets us a problem that will exist for all of our sources of taxable income. How do we relate each of those types of taxable income, here at our first one, employment income, how do we relate that source of income to the tax year in which it will be charged to tax? And for the vast majority of these sources that we will see, employment income amongst them, most notably self-employment not, but then all the forms of investment income we'll see, the main form is the actual amounts that you've received within the tax year, between that 6th of April date and 5th of April date of the following year, the actual amounts received. But when it comes to self-employment, if you choose to go down that route, we have that problem, don't we? Now, some traders, to make life easy for themselves, will keep their accounting period synonymous with the tax year, and may go either very precisely a year ended the 5th of April, or the next best thing to it, a year ended 31st of March. We do our apportionment to the nearest month, so effectively in terms of the profit that would be identified, it'd be the same thing. Not all businesses, though, will do that. We know that there may be different reasons for choosing different accounting dates, the seasonality of the business, for example, there. So we must have a system whereby, for whatever date the self-employed person prepares their accounts, how do we relate the profit of that period to the tax year in which it will be assessed? Now, that area is a very large area, dealing with the self-employed. What we have here is Chapter 2, that deals with the income tax computation. And on that income tax computation, the trading profit of the unincorporated trader is just one item that features here. But our income tax studies, the stuff that goes into in detail what we see in Chapter 2, the income tax computation, the study of income tax and the self-employed in particular covers several chapters. We see here that we're going to bring in a trading profit. We know already we have a problem. How do we relate the trading profit of an accounting period to the tax year in which it will be assessed? An accounting date that could be any date, normally month ends, of course, but how do we relate that to the tax year in which those profits will be assessed? And I say those profits, there's another problem that we have. The accounting profit is not the same as the adjusted trading profit that you will see here on the income tax computation. This is a tax-adjusted trading profit. No matter how good we have been in terms of our accounting, our bookkeeping, in terms of maintaining the accounts of the unincorporated business, it is not that accounting profit that will be acceptable for taxation purposes. There's a process of adjustment that we need to look at. In Chapter 4, we look at that process of adjustment to profit, whereby, starting with what the accountants have given us, the accounting profit for a given accounting period, how do we adjust that up for taxation? And what we'll discover there is that the vast majority of the work, probably in excess of 90% of the work in terms of any exam question, is all about looking at the debit side, technical term, debit side of the statement of profit or loss, i.e. looking at the expenses. Because although all those expenses that feature on the statement of profit and loss will have been validly incurred in terms of that business. Not all of them, and it might not sound fair here. Yes, as we'll go on about this a lot over the studies of taxation, the F word, fair. Fair has got nothing to do with it. Taxation is built on rules. Rules created by people in government there. And those rules may change from time to time. But whether we like them or whether we don't, we have to learn those rules. But what has been a standard feature of establishing that tax-adjusted trading profit of the individual, the unincorporated trader there, the standard process of adjustment of profits has mostly been the same ever since I was a lad and was studying this for myself. And trust me, that is a very long time ago. And one of those adjustments of profit that will live in your memories from now on till the end of time is that they take a particular expense, the depreciation charge, which we know is a perfectly allowable business expense for accounting purposes. But that depreciation charge will be disallowed in the so-called adjustment of profit. So when we start with our accounting net profit, we will recognise that, there's expenses on that statement of profit or loss, like depreciation, that are not allowable for taxation. With depreciation, it's the entirety of the depreciation charge that will be disallowed. With other expenses, it will be an analysis. Most of it may be allowable, but some part of it may be disallowed. Now, all those rules await us in Chapter 4. But what we'll do there, start with the accounting profit, the net profit as per the statement of the profit and loss there account, that statement of profit or loss. And if there are expenses that have been clearly deducted in deriving the accounting profit, but they're not allowable for taxation purposes, then they'll be added back in the adjustment of profit, increasing the accounting profit to make it acceptable for tax purposes and deriving the tax-adjusted trading profit. Chapter 4 gives us those rules. These are the things that are perfectly allowable, or more specifically, these are the ones that are not. Those are the ones that you have to remember and know how to deal with when facing that task within the examination of adjusting the statement of profit or loss and making it acceptable for tax purposes. Chapter 4. Chapter 5 deals with something we call capital allowances. I've just said to you that the most notable expense on the statement of profit or loss that needs to be adjusted for is the depreciation charge. We add that back in the adjustment of profit. But all is not bad news. Clearly, adding back is not good news to begin with. It's increasing the accounting profit to a higher taxable trading profit and therefore increasing our tax. We don't like that. But what happens with depreciation is that what we do is to replace it with a formal system, the HMRC, Her Majesty's Revenue and Customs there, their system whereby they do give tax relief for qualifying capital expenditure that has been incurred. So in Chapter 5, we'll have that process of establishing for the accounting period of the trader, given the assets that have been bought and sold or held throughout that period, what capital allowances will be available. And that process that we look at in Chapter 5 will give us a capital allowance for the period that we will have deducted in deriving this tax-adjusted trading profit that ultimately hits this computation. So there's one problem dealt with in 2 chapters, 4 and 5, making the accounting profit from the statement of profit or loss acceptable for taxation purposes. Something that is eminently examinable so far as your exam is concerned. It lends itself both to Section A questions where individual issues within the adjustment of profit may be tested, all the way through to in Section C, of course, where we're dealing with our written answers to those written questions, whereby it could be part of a 15-mark question, a guaranteed 15-mark question, of course, for income tax that we have in Section C, again, which you will know if you have read the if you've watched the introductory lectures. And again, if you haven't and you're still watching this, go back and watch those introductory lectures, please. But if we've watched those introductory lectures, we'll be aware, therefore, that we will have established for the unincorporated trader our tax-adjusted trading profit, combination of Chapter 4, adjusting the statement of profit or loss for the principally the items of expense that are not allowable for taxation and adding them back to the accounting profit, but then with a hopefully substantial deduction, replacing that with capital allowances. Now that gives us and solves that one problem there. What's the trading profit to feature on the computation? But then there was that second problem. How do we know which accounting period, which particular year ends profit, as adjusted for taxation purposes, should appear here in this income tax computation for this particular tax year? Now is not the time to try to answer that question. We've got to get to grips with the content of this computation and how we then proceed to tax our taxable income figure to establish a tax liability. But Chapter 6, a whole chapter, will be devoted to how we do relate any given accounting period, which isn't necessarily just a normal accounting year end. For a normal accounting business, that bit will be very quick and easy. But what makes life more interesting, dare we say, is what happens when you've got a new business starting to trade, where it starts on any given starting date and prepares accounts then for its first accounting period to any chosen accounting date, where that opening period isn't necessarily exactly 12 months. It doesn't form an accounting year end. It's either a short period or a long period. How do we deal with that in the opening tax years? What happens when a business ceases to trade? Yep, there are special rules for dealing with opening years and closing years. And that's why that issue about relating any given accounting profit as adjusted for tax to the tax year has its very own chapter, Chapter 6. We don't stop there. In Chapter 7, we look at what has sadly been the case for many businesses over recent years, given the pandemic and what businesses and individuals have had to endure over these years. A business doesn't always make a profit. Sadly, sometimes it will make a profit. Now, if HMRC, as they are going to tax us when there are tax-adjusted trading profits, then equally they must give relief for trading losses when they are sustained. And there isn't just one way, there are several ways by which any such trading loss for any given accounting period, from when you start, when you continue to trade, when you cease to trade, the way that trading loss will be allowed for taxation purposes. You can then choose to a degree between those available losses. But what they are and how we choose, how we apply those reliefs, well, that's Chapter 7. Chapter 8, still with the unincorporated trader. Up until now, though I've mentioned, of course, partnerships as being one of the two forms of unincorporated trade we need to know how to deal with. We've basically been talking as if the business belonged to one person, it was a sole trader, and whatever was the tax-adjusted trading profit on that accounting period, once we've learned to relate it to the tax year, all of that profit will go to one person's income tax computation. But if it's a partnership, of course, though again, as with Chapter 4 and 5, we start again. We do the statement of profit or loss for the partnership's statement of profit or loss, not each individual partner. We do the statement of profit or loss for the partnership. We compute and deduct the capital allowances for the partnership. We get a tax-adjusted trading profit of that partnership. But then we have another problem. We don't tax the partnership. We tax each partner on their share of that partnership profit. So what you've got is, well, a numbers game, a mathematical problem. How is it that we'll divide out that agreed tax-adjusted trading profit of that accounting period. How will we divide it between the various partners? And of course, as you'll know from your accounting, the way that the profits would have been divided between the partners is based on the profit sharing agreement in force during the accounting period. So Chapter 8, very mechanical exercise, will be how do we do that? How do we divide out that tax-adjusted trading profit of the partnership between the partners so that each partner can take their share of the tax-adjusted trading profit and include here that share of that partnership profit on their personal and individual income tax computation? That's the nature of the problem to be dealt with in Chapter 8. So all of those chapters from Chapter 4 through to Chapter 8 deal with the self-employed. So it's one little figure here, the trading profit. But any work involved in terms of any of 5 chapters could be involved in establishing, one, the trading profit that features there, and of course what may then be deducted from it, if it exists, if there's any trading loss that's been brought forward from a trading loss sustained in an earlier period that has not, as at the start of this tax year, been fully utilised, then any such trading loss brought forward will be deducted here against this, as it is for, in respect of that loss, the future trading income of that trade. So all of that in those chapters from 4 through to 8. Of course, work, we said, may be employment income. Now, employment income, although it only has one chapter, Chapter 9, is a very big chapter. Because, again, employment income isn't just one thing. It isn't just your set salary or wage there. It isn't just the salary or wage that has actually been received, though that is the basis of assessment, received, that has been received in this tax year. We're going to have, most likely, something that's rather more interesting, a very more interesting employee. And one day, if not already, you might have some of these characteristics as regards your employment income as well. Because if an employer wishes to remunerate an employee in ways other than cash, then there's a whole range of benefits that may be provided by the employer to the employee. And although, as we'll see in Chapter 9, quite a lot in terms of the number of different items, not much when it comes to the value of those. But most of those benefits that have been provided will be taxable. Some of them, as I've said, quite a long list, but not very much in terms of substance. Some of them will be exempt. Clearly, when you come to Chapter 9, as with all of these chapters, you've got yourself another learning exercise there. Learning what are at least the main types of exempt income, and then, although I know it's the salary received in the tax year that will go to this income tax computation, what about these benefits? What other benefits could have been provided? Well, of course, there's the classic and most likely one and most frequently tested one. That is that the individual employee is provided with a car by the business for which they work. Usually, of course, a company, but any business that provides them with a car, that will be known as a company car there, even if their employer isn't a company. But the benefit of the use of a motor car provided by the employer. And that's a big one. And again, I cannot imagine an exam where, at least in Section A, if not in the later Section C, they haven't tested you in relation to at least one assessable car benefit. Now, that's just the tip of the iceberg. There's a whole range of different ways by which the employer may provide benefit to the employee, and which we need to learn the rules of, by which HMRC have determined if that benefit is provided to an employee in a tax year, then this is the way that you will establish the assessable benefit in relation to what has been provided by the employer. Rules. Again, rules that we have to learn. But not just yet. That will be Chapter 9. At the moment, what you'll see in terms of the examples that we put together here for our income tax computation, at least for our Finance Act 2021, the 2021-22 tax year, we'll just be given in this chapter, here's a figure of trading profit. It will be the correctly adjusted trading profit. Here is a figure of employment income there. It is the figure of employment income that you need to include. How we get the detail of those numbers, where that comes from, those are the later chapters that flow on from this first chapter that says, if we've got all these individual numbers, we've got all those figures acceptable for taxation, how do we put them together on this income tax computation? And then, having established a figure of taxable income, how do we then proceed to calculate the tax liability? And maybe even a further step, as we'll see shortly, the tax payable figure. Although most certainly the tax liability would be asked of us. Okay. Before we go any further in terms of the different types of income that we might have, we said it would come principally from work, hence employment, self-employment. It could also come in other forms. It could come in terms of, well, through our work, we have some savings that we make out of our salary or wages, and those are invested in a deposit account, for example, a bank account that pays interest, so we may have interest income. In addition to interest income, we may have dividend income. We get to the stage where we've got a little bit more spendable capital, and we buy shares in a company. And all being well, that company makes a profit and distributes some of those profits to the shareholders in the form of dividends. So we may have dividend income. We'll discover that in relation to interest income, we have a special name for that when it comes to the content of this income tax computation. We call it savings income. But again, more of that in a moment. Right, just go back to our introduction here. Now, again, as I said to you during the one of the introductory lectures, there are two main parts to the income tax computation. Two main parts. And this is a common feature of all tax computations that will be done, whether it's for an individual or whether indeed it is for a company and we deal with corporate tax. The first thing to do is to establish what is chargeable to tax. For us here, firstly in our computation, the taxpayer's taxable income. The taxpayer's taxable income here. That will be the first part of the income tax computation completed. The computation of the taxpayer's taxable income. But having got it, of course, what do we then need to work out? The tax thereon. And that principally will be the calculation of the income tax liability and or income tax payable. There used to be rather more differences between the liability and the payable. Now there's only one difference. So again, read the question carefully, of course, and as we'll focus on and stress throughout these lectures, when doing an objective testing question, make absolutely certain that you do focus on the exact requirement and don't just assume. So here, has it asked for tax liability or has it asked for tax payable? You need to know. In an objective testing question, there would be two of the figures are out of the four provided to you to choose from. One would be the liability, one would be the payable. Make sure you've read what it was that was required. How we differentiate between them, should it be necessary, we'll see at the bottom of our pro forma in a moment. Then the taxable income that we include here will be divided into three possible analysis columns. Now, one of them is very obvious. By its name, it's purely one source of income, dividend income. It is kept separate in its own column. If you look at that pro forma computation here, out the other way, there we go. there is your dividend income. Another column that we will also use is savings income. And that is the fancy name that we give for what is our interest income. Interest income is known for tax purposes on the computation as savings income. And once you've identified those, any and all other forms of taxable income will be known as non-savings income. And that will be mostly made up of, well, two items that we already know about that we have discussed, that being employment income and the trading profit of the self-employed, the unincorporated trader, but another one in there as well that we haven't yet mentioned, property income. Another form of investment. You didn't have just a little bit of money to put into a bank or to buy a few shares with. You had quite a lot of money, and you've used that to buy a property that is then let out. And that therefore provides you with property income. So we've got non-savings income, employment income, your trading profits of the self-employed, and property income. Now, why is it that we have to list out these various sources of income, not just in one column, in one single row, but as divided in between those three categories? And the reason is this. The analysis is required as different tax rates may apply to the different types of income. So what we're going to discover is there are various different tax rates. Once you've got your taxable income, that's part of the problem solved, but then there's a tax calculation to perform, be it purely just tax liability or moving on from tax liability to also or purely compute tax payable. What we will see is that depending on the type of income and how much income we have, there will be differing tax rates. Income tax is a progressive taxation. If you had a little look at Chapter 1, which you needn't have necessarily done by this stage, I would hasten to add, that can come at the end of your study of the detailed taxes. Knowing how each tax works, how to compute what is chargeable under each of the taxes, how to compute the tax thereon, whether it's income tax, whether it's corporation tax, capital gains tax, inheritance tax, national insurance contributions, VAT, whatever it is. Once we've been able to establish, of course, all of those figures of income here in the income tax computation that are chargeable to tax, income tax is a progressive taxation because what it means is that as your income gets higher and goes above certain limits, you move into a higher rate of taxation. We'll start with what we know as our basic rate of tax. We'll move as income gets higher and you go over a certain level of income, a basic rate band limit, into, well, appropriately named, the higher rate of tax. And that's quite a big band for higher rate taxation. But if you have lots and lots of lovely taxable income, then you may get as high as additional rate, which is, of course, an even higher rate of taxation. So we have two things that impact on the tax rate of our taxable income. And we need to know the makeup of it because there may be different tax rates that apply to the different types of income, non-savings, savings, and dividend income. And then as you move higher through the levels of income, taxable income, then you may move to higher rates of tax in relation to all of those different types of income. So in computing taxable income here, our UK taxpayers, it's not all bad news, you'd be pleased to hear, may be entitled to a deduction of a personal allowance. Now again, if you live and work within the UK, you will be familiar with certain aspects of the UK taxation system, and you'll be aware that you are entitled to a personal allowance. That is quite simply a level of tax-free income. And it's set by the government each tax year. If you studied tax for an earlier tax year, the 2 years before this, we had £12,500 as the level of personal allowance. Now, it hardly seems worthwhile adjusting it, but for 21-22, that's gone up to the princely sum of £12,570. If only they'd left it alone, then it would have made the updating of these notes a whole lot easier, so far as I was concerned. But no matter. It's £12,570 for the 21-22 tax year there. And that is a level of tax-free income. So having established to begin with your total income figures in terms of what's non-savings, what's savings, i.e. interest, what's dividend income, i.e. dividends there. Once you've got those figures, there will be there's other possible deductions, but there's one main deduction to bring you down to taxable income, your personal allowance. And that's the £12,570. And what we'll discover, and a reason why on this pro forma computation here, that we run these as well as a total column, which of course we will have non-savings income, savings income, then as we've already identified, dividend income. And that is an order of those columns that you must maintain, because any deductions from those sources of income, here we've introduced this personal allowance, this level of tax-free income, as well of course as being deducted here from the total, will be deducted firstly from non-savings income. If we're going to have to find a figure of taxable income, not just in total, but its makeup in terms of non-savings, in terms of savings, and in terms of dividend income, then you need to know whether primarily this deduction, but there are some other deductions here that get deducted from total income to bring you to net income, to then bring you to your bottom line taxable income. We need to know the order in which those deductions are made. And that's why you've got the rows, the columns in this order. Because the deductions are firstly from non-savings. If, and it could happen probably in an objective testing question in section A rather than a section C question, but if that personal allowance of £12,570, if that was bigger than the net non-savings income, then any amount of that unused would then be deducted there from your savings income. And if there was insufficient savings income again to consume the deduction of the personal allowance, then it would move to dividend income. So the order of set-off, it will be given in these notes, do not worry, but is in that order. So get used to the idea that when you prepare an income tax computation, we're going to run the analysis columns as well as the total column. Now, given that you may be doing a mini little exercise as a section A question for only 2 marks, then of course, as there is no workings to hand in, it's to get the right answer or not, then you may abandon the structure of this computation. But you still need to know the way in which each form of income is established, where deductions go against those sources of income, non-savings before dividend, and having got then the taxable income, how do we proceed to tax that through the various tax bands? Okay. There was a little asterisk here as regards employment income, and that employment income, our salaries or our wages, that's just are you paid monthly, are you paid weekly, salaries paid monthly, wages paid weekly, must be included gross before deduction of taxes at source by the employer. Yeah, what we have here is that employers, when they pay their employees, are required to deduct at source the relevant amount of income tax and as we mentioned in our introductory lectures as well, more about those introductory lectures, make sure you see them, the national insurance contributions that may be payable by the employee, it is the job of the employer through what is known as the Pay As You Earn system, PAYE, the Pay As You Earn system. It's the employer's duty to deduct at source before a net amount of pay is paid out to the employee. The employer has to make those deductions for all their employees collected up for the month and paid over monthly to HMRC. It's their responsibility to do that. Quite a good system, isn't it, for HMRC? They've got the employers to do the dirty work for them, to collect that tax at source. It makes their administrative job and, of course, their collection job a whole lot easier because somebody is doing it for them, i.e. the employers. So any figures of salary or wage provided to you will be basically on an annual salary, and they will be gross figures before any such deductions of either income tax or NIC have been made through the pay-as-you-earn system. Deductions then from total income, there's a couple of asterisks there, in terms of qualifying interest payments and other trading loss reliefs. Deductions, as we've just said, from total income and the deduction of the personal allowance from net income are deducted in order from, now you know this, firstly, non-savings income, then savings income, and finally dividend income, for purposes of this exam. In reality, it doesn't always work that way. There are situations where the taxpayer is allowed, because it improves their tax position, to do it differently, but that's not an issue for you. You will always apply those deductions, whichever they are, either the deductions of qualifying interest and various other trading loss reliefs. We saw one trading loss relief at the top here, a trading loss brought forward. If there's a trading loss this period or in a future period that's come back to this year, anything other than a brought forward loss, as we discover in Chapter 7, and you won't look at this until we get to Chapter 7, those other loss reliefs will come out there. But those deductions will be made in that order: non-savings income before savings income before dividend income. Loss reliefs, as I said, are covered in detail in Chapter 7 and should not be studied until you reach that chapter, till we reach that chapter. Don't go looking ahead just because I've mentioned them. Fascinating though, of course, they may be. Now, of course, sandwiching between your main sources of income, employment and trading income for the self-employed, and ultimately the deductions from that income allowable for taxation, we've got other possible forms of investment income. Now that, of course, could be another form of non-savings income, property income. So you'll see in this non-savings column, you've got your trading income, you've got your employment income, you've got your property income. Those are your three forms of non-savings income. Savings income is interest income, of course, and there, well, you'd be used to the idea of bank deposit interest. Banks are commonly used throughout the world. In the UK, I don't know whether it's correct in your particular tax, if you are deriving from a different taxation system in some other part of the world, various types of interest-bearing securities. But another deposit that you could have, another form of saving, and hence savings income, you are saving, you're putting into account that gives you interest, is in what's called a building society interest. Now, you don't have to worry what they are. All you've got to recognise is if it's building society interest received in the tax year, it goes here on the income tax computation, and it's classified here, along with the bank interest, as being savings income. We say there other interest, well, a bit later when we look at savings income. There's rather more detailed notes, so don't bother to make a note of it now. But you might, of course, if you've got more substantial sums available, you might be able to invest in government securities that therefore in their own right pay interest, and also in the form of corporate loan stock, debentures, corporate loan stock. There you may own a security that isn't equity but is loan stock, and therefore what do you get on that as it were payment for having invested in the company? You get interest at a set rate on that loan stock. So those would be your other forms of interest. Now what we've got to get used to, and we'll do this with a lot of practice, is recognizing each type of income, recognizing as we go through the bases of assessment, which to begin with will be very simple because it will be employment income received, property income received, dividends received, and all these different forms of interest received there. It will be on a received basis. It will be a later chapter. It will be chapters 4 through to chapter 8 when we look at the self-employed, and in chapter 6 specifically when we see how to relate any accounting period for which we've established an adjusted trading profit. How do we then relate that to the tax year in which that profit will be assessed? But that is for a later chapter and therefore a much later lecture. But that will bring, I think, this lecture to a close now. Having introduced the concept of the income tax computation, you can see there the different types of income, the outgoings that will be allowable, but they are rare in terms of deductions from total income, the usually always available personal allowance of £12,570 to be deducted from total income to give you net income, and that we must analyse in those three forms. What we'll then be able to go on and do, but that will be in our next lecture together, is once we've established those figures, how then do we calculate our tax liability? And eventually, should it be necessary, how do we calculate the tax payable? But your first task is to get your head around the content, the structure of that income tax computation. Clearly, the detailed structure won't be necessary on a Section A objective testing question, but if you've got a Section C question, which, well, you may, that asks you to prepare the income tax computation for this taxpayer, for our tax year, for us with FA 21, Finance Act 21, it will be the 21-22 tax year, then you need to know this structure. And you also need to know not just the bases of assessment, which at the moment are very simple, received amounts of employment income, property income, interest income, dividend income, but the analysis, non-savings, savings and dividend. Because if you know that, we'll then be able to make that next move in our next lecture to see how it is that each of those figures of taxable income will be charged to income tax.